Let me ask you something that most people never stop to think about. What if the number you've been chasing your whole working life, that big retirement balance, actually stops being the most important thing once you hit a certain point? What if, after decades of saving, the real threat to your retirement isn't a bad market, isn't inflation, and isn't even a medical emergency, but something hiding in plain sight inside the tax code? If you've got over $1 million saved for retirement, or you're on your way there, you need to hear this. Stay with me, because what I'm about to share could literally save you hundreds of thousands of dollars. And if you're new here, welcome to Retire Smart. Go ahead and hit that subscribe button right now and tap the bell so you never miss a video. We put out strategies every week that most financial advisors won't sit down and walk you through. This is the kind of content that could completely change how you think about your retirement. Hit subscribe, it takes 2 seconds, and it could be worth a fortune. Now let's get into it. There is a number, and for most people it sits somewhere around $1.5 million in retirement savings, where the entire game changes. Below that number, your job is simple. Save more. Invest wisely. Grow the balance. But once you cross that line, continuing to focus only on growing your net worth is like a football team obsessing over how many yards they gained, when all that actually matters is whether they scored points. The scoreboard shifts. And if you don't recognize that, the IRS will quietly take a massive slice of everything you built. Here's the core truth that changes everything. Your net worth is just a snapshot. It's a still photo of what you own at one moment in time. But the IRS doesn't tax snapshots. The IRS taxes income, the money that flows out of your accounts and into your hands. And for most retirees with significant savings in traditional IRA letters or 401ks, that flow of income is going to be forced by law whether you want it or not. That's the part most people never see coming until it's already happening to them. So let's talk about how this actually works in real life. When you save money into a traditional IRA or a 401k, you got a tax break on the way in. The government said, go ahead, we won't tax this now. But here's the catch: they never advertise loudly. They fully intend to tax it later. And not just a little. They've built a system called Required Minimum Distributions, RMDs, that essentially forces you to pull money out of those accounts on their schedule, not yours. If you were born in 1959 or before, RMDs kick in at age 73. If you were born in 1960 or later, they start at 75. Either way, once that clock starts ticking, you don't get to choose whether you take the money. You have to. And every dollar you take out gets added to your taxable income for that year. Now let us put some real numbers on this so you can feel the weight of what we're talking about. If you have $1.5 million sitting in a traditional IRA, when you turn 73, your first required minimum distribution is going to be somewhere in the neighborhood of $56,000. If you wait until 75, that first forced withdrawal is closer to $61,000. And these numbers grow every year after that as the IRS tables adjust. But here's what catches people off guard. This isn't happening in a vacuum. That $56,000 doesn't just sit alone on your tax return. It stacks on top of everything else you're receiving that year. Think about what that picture looks like. You've got your RMD income coming in. You've got Social Security payments coming in. Maybe you've got some dividend income from investments. Maybe some interest from savings. Maybe a little part-time work or rental income. All of that gets layered on top of each other. And suddenly you're looking at a total income number that pushes you into a tax bracket you never expected to be in. This is what's called income stacking, and it's the silent retirement killer that almost nobody talks about until they're already living it. Your net worth could look completely healthy on paper, while taxes are quietly chewing through it year after year. And Social Security makes this even more complicated. A lot of people assume their Social Security benefits are just theirs, money they paid into the system, money they earned, money that comes back to them tax-free. But that's not how it works. Depending on your total income in retirement, up to 85% of your Social Security benefits can become taxable. So when you add that forced RMD income on top of your Social Security, you could trigger taxes on benefits you thought were protected. That's a double hit that nobody warned you about when you were filing those payroll taxes every paycheck for 40 years. And then on top of all of that, there's Medicare. Most people know Medicare helps cover healthcare costs in retirement. What most people don't know is that your Medicare premiums are not fixed. They can increase based on your income. There's a system called IRMAA, the Income-Related Monthly Adjustment Amount, and it means that higher income equals higher Medicare premiums. Here's the part that stings the most. Medicare looks at your income from 2 years prior. So decisions you make about IRA withdrawals today could suddenly bump up your Medicare bills 2 years from now. You might think you planned things perfectly, and then receive a notice that your premiums just jumped significantly, and trace it back to withdrawals you made when you thought you were being smart. These hidden connections between your withdrawals, your taxes, and your Medicare costs are exactly why retirement planning above a certain balance is no longer just about growing the money. It's about managing the flow. Let me give you a simple example that really puts this in perspective. Imagine you're 73 years old. You take your required minimum distribution. Let's say it's $56,000. Your Social Security benefit is about $40,000 a year. Right there, without doing anything else, you're already at $96,000 of income. Add in any dividends, interest, or other sources, and you could easily be looking at over $100,000 of taxable income, even if you're living modestly. That's not a wealth problem, that's a tax sequencing problem. And it's 100% preventable with the right planning. So what does smart planning actually look like? The most powerful tool that too few retirees use early enough is the Roth conversion. Here's the idea. In your early 60s, before RMDs begin, before Social Security stacking starts, often during a window where your income is lower than it will be later, you can take money out of your traditional IRA, pay the taxes on it at today's rate, and move it into a Roth IRA. Once money is in a Roth, it grows completely tax-free, and when you pull it out in retirement, it doesn't count as taxable income. It doesn't trigger higher Medicare premiums. It doesn't push your Social Security into the taxable zone. It just sits there working for you, silently, without handing a cut to the IRS every time you touch it. The reason this matters so much is timing and control. If you don't do Roth conversions before your RMDs begin, you lose control of the timing. The government forces your hand. They tell you when to take the money, and how much, and you pay taxes at whatever rate applies that year. But if you convert strategically in your 60s, a little each year, filling up lower tax brackets without crossing into higher ones, you can reshape your entire retirement tax picture. You're essentially paying taxes on your terms, instead of letting the IRS pick the worst possible moment for you. Now, there's another piece of this that doesn't get nearly enough attention. And it's something that affects most married couples at some point. It's called the widow's tax. And the name says it all. When two spouses are living together in retirement, they file their taxes jointly. Married filing jointly gives you wider tax brackets, a higher standard deduction, and generally more room before income starts getting heavily taxed. But when one spouse passes away, the surviving spouse files as a single person. Their tax brackets shrink dramatically, their standard deduction drops. And here's the brutal part, their income often doesn't drop at all. Social Security might decrease slightly because you drop from 2 benefits to 1, but the RMDs keep coming. The investments keep generating income. The expenses of life don't just cut in half. So the same income that was perfectly manageable on a joint return can suddenly push a surviving spouse into a much higher tax bracket, costing tens of thousands of extra dollars per year in taxes. Planning for this scenario even when it feels uncomfortable or premature, is one of the most important things a married couple can do before retirement. This is why two people with the exact same retirement balance can end up in completely different financial situations 20 years into retirement. Imagine two retirees, both with $1.5 million saved. Both healthy, both retired at the same age. One of them takes the time to do Roth conversions in their early 60s, coordinates their Social Security start date carefully, thinks through the widow scenario, and maps out their withdrawal strategy in advance. The other one just lets things happen naturally, takes Social Security when it feels right, waits for RMDs to start, and reacts to tax bills as they come. A decade or two in, those two people could be hundreds of thousands of dollars apart in terms of actual wealth. Not because of investment returns, not because of spending habits, purely because of tax planning decisions. The earlier you start thinking about this, the more options you have. In your early 60s, before most of these systems kick in, you have maximum flexibility. You can run the numbers on different Roth conversion amounts. You can model different Social Security start dates and see how they interact with your projected RMDs. You can stress test your plan against different scenarios. One spouse living significantly longer than the other, healthcare costs spiking, tax rates changing. Every year you wait to start this kind of strategic planning is a year of flexibility you never get back. Here's the mindset shift that I want you to take away from this. Up until a certain point in your financial life, success is measured by how much you accumulate, save more, earn more, grow more. That's the whole game. But once you've crossed that threshold, once you've done the hard work and actually built significant retirement savings, the game changes completely. Now success is measured by how much you keep, not how much you have on paper, but how much actually ends up in your pocket after taxes, after Medicare adjustments, after every system that's designed to take a piece of what you've built. Net worth is the beginning of the story, not the ending. What you do with it, and when, and in what order, determines whether that number translates into real financial freedom or quietly shrinks away under layers of avoidable taxes. I want to say that one more time because it's that important. Adding another $100,000 to your retirement balance might be far less valuable than avoiding a $50,000 tax hit that you could have prevented with the right planning. Bigger isn't always better once you're past a certain point. Smarter is better, more strategic is better. And that strategy starts with understanding exactly what forces are going to act on your money once you stop working and start withdrawing. So here's what I want you to do. Start having this conversation now, not when you're 72 and the RMDs are already here. Talk to a financial planner who specializes in retirement distribution, not just accumulation, and ask them specifically about Roth conversion strategies, Social Security timing, IRMAA planning, and survivor planning. If you don't have a planner, use the resources available to you, including content like this, to at least understand the landscape before you're in the middle of it. And look, the fact that you're watching this, that you're here asking these questions, already puts you ahead of the majority of people heading into retirement without any of this context. Most people spend more time planning a vacation than they spend planning 20 or 30 years of retirement income. You're already doing something different, and that matters. If this video gave you something useful, do me a favor, drop a comment below and let me know what part hit hardest for you. Was it the RMD income stacking, the IRMAA Medicare connection, the widow's tax situation? Tell me where you're at and what questions are coming up for you. Your comment helps other people who are in the same situation find this content, and it helps me know exactly what to cover next. Share this video with someone you know who's in their 50s or 60s and building toward retirement. This is exactly the kind of thing most people wish they'd learned earlier. And if you haven't subscribed yet, do that right now. Every week on Retire Smart, we go deep on the strategies that protect and extend your retirement wealth. You've worked so hard, and too long to let avoidable mistakes take what's yours. This is retire smart. And the whole point is not just building wealth. It's building it in a way that actually stays with you.